The silver market just fired a warning shot, and most people heard it as noise. Not a rumor, not a meme, not a candlestick pattern, a structural snap. Paper promises are getting pulled toward physical delivery, and the inventory behind those promises is not keeping up. That's what happened. And if we're reading this correctly, the price you see on a screen is about to matter a lot less than the metal someone can actually place on a scale. Let's go. Here's the setup nobody wants to say out loud. Gold is priced like trust is cracking. Silver is priced like everything is fine. That gap is the fracture line. Fact. For more than a century, gold and silver have traded in a relationship that keeps snapping back toward a long-run range. Interpretation. When that relationship stretches too far, it doesn't glide back. It whips back. And right now, it's stretched like a rubber band in winter. If gold stays elevated and silver simply drifts back toward a boring ratio, silver doesn't need a miracle to move. It just needs gravity to switch back on. Now watch the trap. People hear gold to silver ratio, and they treat it like trivia. A cute statistic, a fun chart. It's not cute. It's a pressure gauge on the entire metals complex. And pressure gauges don't care about our opinions. If that ratio compresses, if it even leans toward levels we've seen in normal decades, silver's math accelerates fast. Could silver print numbers that sound insane today? Yes. But the darker point is this. In a squeeze, the number becomes secondary, because the market stops being about price and starts being about access. Do you feel the difference? Price is what you pay. Access is whether you can get it at all. Now let's talk about the machine that manufactures the illusion. Most silver trading isn't silver trading. It's IOU trading. Claims stacked on claims, like receipts for a product that hasn't been boxed yet. And that system looks stable right up until the moment too many people show up asking for the same package. This is where things get uncomfortable. Fact. The real-world mine pipeline is relatively fixed in the short term. Most people assume miners can turn the tap when price rises. They can't. A huge portion of annual silver output isn't even produced by companies that care about silver. It comes along as a byproduct of copper, zinc, lead, tin, base metals that drive the business. So even if silver screams higher, those producers don't magically ramp silver output. They ramp what they mine for. Silver is the passenger, not the driver. Interpretation. That makes supply stubborn. And stubborn supply plus rising delivery demand is how squeezes get born. Now here's where it gets spicy. In calm markets, longs and shorts roll obligations forward. They net out. They settle with paper. Everyone pretends the tower of claims is fine. But when confidence cracks, one thing changes. People start asking for the metal. And the moment that starts, both sides of the trade get dragged toward physical reality. Because once delivery becomes the battlefield, the paper tricks lose their power. Now watch this. If paper claims are multiples of the underlying metal, if the promises are hundreds of times larger than what exists in deliverable form, what happens when even a small percentage demands delivery? Exactly. The system doesn't need everyone to panic. It only needs a few percent to stop playing the paper game. That is what encroachment into physical really means. It's not a headline, it's a slow-motion bank run. Now add the geopolitical twist that makes this more than market plumbing. For years, one refining hub has been a quiet lever in global silver flow. When a nation dominates refining, it can smooth supply, it can slow releases, it can absorb metal quietly, it can suppress volatility. But control only works while you believe you can maintain it, and the moment that belief breaks, the incentive flips. Instead of feeding the world, you start stockpiling. Instead of exporting freely, you tighten licensing. Not because you're a villain, because you're rational. If you believe the price has to move higher, you don't ship strategic material at yesterday's paper quote. You keep it inside your walls. And when that flow tightens, who feels it first? The biggest importers. The buyers whose demand is cultural and industrial at the same time. The places where people would rather hold metal than hold fragile currency. Here's a pattern we've seen before, and it matters. When trade tensions rise, countries don't start by banning everything. They start with the stuff you can't replace. First, it's licensing delays. Then it's national security language. Then it's quotas. And one month you wake up and realize the supply you assumed was global is suddenly domestic. We've already watched this play out in other strategic materials. Once the precedent exists, metals like silver don't live in a vacuum. So if refining hubs begin to slow exports, it doesn't have to be a dramatic announcement. It can be quiet paperwork. It can be administrative review. It can be a new stamp you can't get. And the result is the same. Less metal hits the global market. More metal gets trapped behind borders. Now think about what that does to buyers who can't wait. If a major importer needs silver for industry, for investment demand, for cultural buying, what do? They don't write angry tweets. They go to the places where the metal is supposed to be deliverable, and they stand there with a ticket that says, deliver. That is how the pressure migrates. It moves from the mines to the refiners to the vaults to the exchanges. And exchanges were built for trading, not for everyone asking for pallets. This is where the paper tower gets tested. London-style derivatives can be enormous because most of them are never meant to touch a bar. They're meant to be rolled, offset, netted. But if even a fraction turns into delivery demand, the math changes overnight. And currency anxiety doesn't stay contained. It bleeds into silver because silver is the cheaper, smaller market with more torque. That's why silver's moves can look absurd. Small market, big emotions, tight physical, one spark. Now connect that to 2026 because the calendar matters. Markets can price tomorrow's pain before the news admits it. If growth slows and policymakers respond with easier money, the nominal numbers can look okay, while purchasing power quietly gets hollowed out. That's why we don't worship headline GDP. GDP can rise while people feel crushed. Because GDP can reflect credit expansion and government spending more than real productivity. So we watch the ground level signals: hiring, layoffs, small business surveys, regional reports that describe reality, not theory. When those reports sour and gold stays firm, it's a message. It's saying, we expect the currency to buy less. And if the currency buys less, hard assets don't need hype. They need math. Here's what's wild. Even when prices rise, scrap doesn't always flood back. Everyone assumes higher prices shake out selling. In some regions, it does the opposite. People look at their currency, look at their metal, and decide the metal is the safer savings account. So the scrap will save us story can fail right when the market needs it most. That's not theory, that's human behavior. And human behavior is the hidden variable that breaks models. Now let's talk about the choke point: delivery. There are claims circulating about how much metal has been stood for delivery on major venues this year, and the significance isn't the last decimal. The significance is the direction. When delivery requests swell toward a meaningful slice of annual mine supply, it exposes the mismatch at the heart of paper pricing. Because if an exchange is truly a warehouse system, it should handle delivery smoothly. But if it's mostly claims, delivery demand turns into a liquidity crisis, and that's when a cheap paper price becomes suspicious. Now watch this contradiction. We're told silver is plentiful because the world mines hundreds of millions of ounces, but at the same time, the tradable inventory that can actually be delivered is thin, concentrated, and already spoken for. That's like saying water is abundant because oceans exist while your city reservoir is empty. Try drinking the ocean. Markets trade the reservoir. So the question for us isn't how much silver exists on Earth. The question is how much is available, deliverable, and for sale at the price on the screen. That's the only supply that matters in a squeeze. Now let's sharpen the ratio conversation, because there's another layer most people ignore. Silver doesn't come out of the ground one-to-one with gold. The geology itself hints that silver is produced in far greater quantity than gold, yet the market often prices silver like it's disposable. That tells us something. It tells us the paper market has been able to dampen the signal. But geology doesn't care about paper, and when a structural squeeze forms, ratios can reprice violently, not politely. Now connect silver's plumbing to the macro story, because this is where people get blindsided. Gold has been behaving like a thermometer for purchasing power. Not just today's inflation, but the fear of tomorrow's inflation. And here's the uncomfortable part. Markets often sniff out what the headlines refuse to say. Fact: GDP can look fine while the ground-level economy feels sick. GDP captures credit expansion. It captures deficit spending. It can grow while households feel poorer. So if we want truth, we don't stare at one headline number. We look at employment that actually reflects the street. We look at business conditions outside the biggest corporations. We look at what smaller companies are reporting because that's where the real economy breathes. When those signals weaken, we're not dealing with a clean growth story. We're dealing with stress. Here's the twist. Stress doesn't always mean prices fall. Stress can mean policymakers print harder. Stress can mean currencies weaken. Stress can mean the purchasing power of savings gets sacrificed to keep the machine running. That's why gold can rise even when growth is soft. It's not celebrating the economy, it's warning us about the money. And when gold sends that warning, silver doesn't stay asleep forever. Silver is the more volatile cousin. It lags, and then it sprints. Now, before we get reckless, we have to speak responsibly. This is educational. We manage risk. We don't gamble on one target. We map conditions. If physical strain eases, if premiums collapse, if delivery demand fades, the squeeze narrative weakens. That's our check. But if delivery stays strong, if export flows tighten, if large buyers keep pulling metal off the market, the upside case strengthens. Notice what that means. Our thesis doesn't require perfection. It requires pressure to persist. And pressure is exactly what delivery demand creates. Now let's go deeper into the paper versus physical split, because this is where most people get tricked. Paper markets can print infinite claims. Physical markets can't print atoms. So when the paper quote dips while physical is hard to source, that's not a real price drop. That's a signal. It's the market flashing. We can quote you a number, but we can't reliably deliver the product at that number. And when that gap widens, the only way it resolves is pain. Either demand collapses, or price rises, or the rules change. Now ask yourself this. If you're a large buyer, industry, sovereign, manufacturer, do you wait for the perfect dip, or do you lock supply? Because if you need the metal to run your operation, you don't care about being clever. You care about not shutting down. That's why squeezes are brutal. They turn rational buyers into panicked hoarders. And once that psychology flips, it feeds itself. Now, let's zoom in on one more invisible threat: confidence. The derivative structure depends on one quiet assumption. Most people will never demand delivery. Most people will trade the claim and go home. But the moment that assumption cracks, the system has only a few moves. It can cash settle, it can tighten rules, or it can let price rise enough to ration demand. None of those outcomes are normal. All of those are regime shifts. And regime shifts are where wealth transfers happen. Now here's the part that makes our stomach drop. When mainstream money finally notices silver, it doesn't arrive gently. It arrives late. It arrives crowded. It arrives emotional. It arrives with headlines that suddenly discover a story that has been building for years. And by the time everyone agrees, the easy phase is already gone. So we don't need to predict the exact top. We need to understand the structure so we don't get tricked by noise. Because noise is the weapon. You'll see a drop that feels like the end, then a rip that feels like you missed it, then another drop that makes you doubt yourself. They want you dizzy. Dizzy people sell the bottom. We don't do that. We measure. So what do we watch? Not the hype. Not the influencer targets. We watch the pressure points where paper has to meet metal. We watch delivery strain. We watch export restrictions and licensing tightening. We watch whether scrap actually shows up. We watch physical premiums versus paper quotes. We watch whether big buyers keep standing in line for bars. Because those are the stress fractures. Now, let's kill the "there's plenty of supply" argument gently, but completely. Mine supply isn't a vending machine. New production takes time. Permits take time. Financing takes time. And byproduct supply doesn't respond the way people think. So if we get a near-term demand shock, the supply response is slow. Slow response plus fast demand equals spike. And spikes come with volatility designed to shake you out. That's the psychological warfare. Now here's a final knife-edge detail. When the paper quote and the physical market diverge, the divergence doesn't last forever. At some point, something has to give. Either physical prices drag paper higher, or paper breaks trust so badly that people stop treating it as a price at all. And that second path is the one nobody wants to imagine, because it forces everyone to admit the screen was never the product. The product was the metal. Now I want you to feel the weight of this. If silver can move aggressively on a ratio compression alone, what happens if a delivery squeeze overlays on top of that? Exactly. That's when price forecasts become jokes, because the clearing price becomes whatever level forces sellers to show up. And if sellers refuse, if they'd rather keep metal than hold currency, the clearing price goes higher again. This is why putting a cap on silver in a real squeeze is dangerous. Now I'm going to leave you with two questions, because your answers tell us what our community is seeing. Do you trust paper promises in a market where delivery is tightening? And if gold is already warning about purchasing power, what's your plan if silver wakes up fast? Subscribe, short and simple, so you don't miss the next breakdown. Because the next move won't come with a press release. It will show up as a sudden shortage, a spread blowing out, and a price that gaps before most people can react. And if you think this ends with a tidy, fair value number, watch what happens when the crowd tries to convert paper into metal at the same time. That's when the real price appears.